Well, good morning, Jagender Rana here. And the topic of the day is India urgently needs a natural disaster insurance program. India urgently needs a natural disaster insurance program. India currently does not have a natural disaster insurance program. The country has several climate change adaptation strategies for the agriculture sector, such as the government-backed crop insurance scheme Pradhan Mantri Fasal Bima Yojana, the weather-based crop insurance scheme, and the coconut palm insurance scheme. The two partners recently published a news and opinion website focusing on social and political issues says that a research report published by the State Bank of India in 2023 suggested that the estimated economic loss due to floods in India ranges somewhere between INR 100 billion and INR 150 billion, of which only around 8% was covered by insurance. So this year, losses in Andhra Pradesh due to the floods are estimated to be INR 68.8 billion, whereas the figures for Telangana are estimated to be INR 103 billion. So with Gujarat, Tripura, Kerala, Assam and other flood affected states combined, this year's total losses are expected to surpass last year's. At present, disaster aid is provided through the National Disaster Relief Management Fund, the State Disaster Relief Management Fund, and both funds 80% of the allocation is for disaster response and the remaining 20% is for disaster mitigation. So the total fund released from the combined accounts of SDRMF and NDRMF in the fiscal year ended 31st March 2024 was INR 202.89 billion. So with the increasing incidence of calamities such as floods, cyclones and incessant rainfall in every year in India, policymakers must think beyond existing disaster funds and develop an alternative risk mitigation framework, possibly through the PPP model. Developing a financial risk mitigation model for weather catastrophes would be a step towards climate change adaptation initiatives and achieving India's net zero carbon emission target by 2070. So one option for India to develop such a model is establishing a parametric index-based insurance scheme. Another option for policymakers would be to develop a regional catastrophe pool for states facing similar kinds of calamities every year. So following either strategy would require the government to undertake thorough groundwork, update granular data on weather and geographic conditions and use a scientific method to underwrite risk and estimate loss from a catastrophe for geography. Most importantly, this would ensure better coordination between the center and the states. Because according to the Global Climate Risk Index 2021, India is the seventh most vulnerable country to climate change, making it highly susceptible to extreme weather events. So while the historical rise in temperatures in India has been slightly lower than the global average, projected increase in the future exceeds global rates. In the absence of adaptation measures, extreme river floods and coastal flooding threaten to affect almost 50 million people by the end of the century. Similarly, in the absence of appropriate mitigation policies, a 3 to 10% shrinkage of GDP can be experienced annually due to climate change. The burden of economic stagnation resulting from catastrophes will disproportionately fall on the urban and rural poor. This delineates the need for hedging mechanism to spread out the climate risk both geographically and intertemporally. So the extreme weather events affect the economy in two stages. The initial damage to human and physical capital and the subsequent loss of productivity due to efforts directed towards reconstruction. So one way to ensure the timely, need-based and transparent disbursement of reconstruction funds is by roping in dedicated climate insurance. Climate insurance can pay out claims to insurers in the event of a natural disaster. It can act as a crucial climate adaptation strategy by challenging the excess capital of one agent to compensate for the loss of another with an additional cost premium. The 1990 Intergovernmental Panel for Climate Change report was the first to note the importance of the role of private insurance players in mitigating climate-induced natural disasters. So climate insurance has the potential to enhance both mitigation and adaptation. For instance, insurance companies have the resource capacity to make long-term investments in disaster-resilient projects, allowing for adaptation. However, when premium becomes a function of the environmental cost of a business's operations, insurers can influence industry practices. Lower premium and higher coverage for enterprises with a lower carbon footprint can lead the market towards mitigation endeavors. So the nature of insurance market intervention can acquire two forms. First, the insurance market can incorporate a climate risk assessment component in all the insurance policies, facilitating flow of funds to green businesses. Second, the private insurance market can play a more proactive role in rolling out climate risk insurance policies for sovereign entities like municipalities, state, and national governments to recover from natural disasters. Thus, the market not only serves as a hedging mechanism, but also provides a metric of sustainability of businesses through differentiated premium costs. So in India, some of the most climatically vulnerable and the hardest hit areas are also the poorest. Communities living in coastal areas and hence belongs to one of the most economically compromised and climatically exposed social groups in India. So for instance, Indians lost over US $3 billion worth of assets due to floods, which amounts to 10% of all the global economic loss due to natural disasters. So the recovery process to recuperate from the damage is often slow and infunded, but be deviled with red tapeism and whimsical fund disbursements, making it a fertile ground for federal and state government conflicts. So a study shows that early intervention can have 3.5 times the impact of delayed payments. In this backdrop, the development or deployment of climate risk insurance can provide for a secure and certain source of reconstruction funds to minimize the post-disaster consequences. It can roll payouts to the government administration of the affected areas while also conducting the prerequisite checks and scrutinies to ensure that funds meet their ends. Funds meet their ends. Natural catastrophes insured losses reached a minimum of $20 billion in the first quarter of 2024. This is a global report. So of the 20 billion estimates, $11 billion was due to severe convective storms and $10 billion occurred in the US. So with the record number of storms forecasted in the US in 2024, mitigating these astronomical net cat losses is more imperative than ever. So researchers are investigating if artificial intelligence can help people in disaster-prone areas and their insurers reduce property damage and fatalities. Because the natural disaster requires timely response and a coordinated effort to move people out of the affected region and mitigate damages. In a 2023 study published in Environmental Health Insights, poured through research on Google Scholar to examine the use of AI in disaster risk management and in emergency health management, they found that AI can optimize recovery planning and improve resource distributions by finding the areas most affected that require immediate or long-term help for disaster resilience. So global losses in the first half of 2024 at $120 billion were lower than in the previous year, because $140 billion were there in the previous year. However, 2023 was affected by extremely high losses in connection with the severe earthquakes in Turkey and Syria. So, in a longer term comparison, overall losses in the first half of 2024 clearly exceeded the average values for both the past 10 years and the previous 30 years. So this is difficult to control all these things in a country like India. Because the only subsegment of climate insurance that India's insurance market rolls out is agricultural crop insurance. So with 65 crore farmers, most of whom rely on monsoon, vulnerable to unseasonal rains and pest attacks, strategically promoting and effectively implementing crop insurance can have a huge impact on their livelihoods and well-being. So over 55 million Indian farmers have crop insurance under the Pradhan Mantri Fasal Bima Yojana. Nearly 70 lakh farmers have benefited from it. In the financial year 2021, with claims worth INR 87.4 billion, $1.2 billion transferred to the beneficiaries. Under the interim budget of 2024, the PM's Kisan Sammelan Yojana provided crop insurance for over 4 crore farmers. Another financial instrument to protect farmers against adverse weather conditions is the Weather Indexed Insurance Policy. It is drawn from the Weather Risk Index, which is based on historical data on weather patterns. This can be a fiscally prudent and sustainable alternative to compensate for evaluated crop yield losses due to weather deviations rather than crop damage. So unlike traditional insurance, this method eliminates the need for extensive loss assessment and quantification, resulting in lower administrative cost and potentially reduced premiums. So parametric insurance, which like indexed insurance policies, is paid out immediately when a predefined set of parameters is met. It's being experimented by the state and central governments. So in Kerala, the State Cooperative Milk Marketing Federation has also introduced parametric insurance against heated stress. This is the possible avenue for market expansion. So country-wide parametric policies directly linking the beneficiaries' accounts to the insurers can expedite the payout process and limit the economic costs in the aftermath of any climate disaster. So beyond the traditional crop insurance segment, the Indian insurance market should diversify into other segments too. For low-income individuals and households, micro-level insurance can be useful to secure diverse risks in exchange for a payment of a premium. So these can cover for death and diseases, loss of small-scale assets, livestock, etc. caused due to climate change, induced natural disasters. National or regional governments and large entities can be covered at the macro level under the sovereign insurance. So sovereign insurance is a financial strategy governments use to manage large-scale risks. In addition to climate insurance, there is need for other risk hedging mechanisms such as natural resources derivatives, which allow the contract buyers to safeguard their positions in the physical markets. So this water future exchange in India has given its accurate water availability risk. A water availability index is proposed to compensate for the absence of a physical water market in India. So any stakeholder can hedge their future position by holding an opposite stance in the future market, ensuring themselves against possible risk, given that basis risk is limited. This would serve the same purpose as an insurance policy, but liquid markets would enable faster settlement via immediate squaring of positions. The climate risk insurance can indirectly promote resilient investment by the insurers. Assessing any project or venture for its riskiness, the insurance company can charge higher premiums for projects that do not adopt sustainable and climate risk adaptable strategies. This will accelerate the adoption of greener, sustainable and climate conscious methods. The creation of a climate insurance market in India with appropriate regulation can reduce asymmetrics, low transaction costs, and facilitate a green transaction through differentiated premium costs. So this will eventually create a market signaling mechanism where sustainable practices receive higher preferences from investors. So continuous public-private collaboration, aggressive research and development, and financial innovation will be the keys to an efficient climate risk hedging mechanism. Because this has become now most urgent to provide the climate insurance, and the market has to be created for that, because the natural catastrophes or a natural disaster insurance program is the need of the hour now. Thank you very much.